Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NorthPointe Bancshares Inc. Annual Report. NorthPointe Bancshares Inc. offers a wide range of banking products and services to its customers. The company operates through two main segments, mortgage purchase program and retail banking. Under the retail banking segment, NorthPointe provides various digital deposit banking services, including non-interest-bearing accounts, savings, money market demand accounts, and certificates of deposits. Additionally, it offers personal and business banking services, as well as health saving accounts. The company also specializes in residential mortgage lending through its mortgage purchase program segment. This includes home loans and custodial deposit services. Overall, NorthPointe Bancshares, Inc. provides a comprehensive suite of banking products and services to meet the diverse needs of its customers. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline at NorthPointe Bancshares, Inc. can be categorized into several key areas. Interest rates play a significant role, with changes in interest rates leading to fluctuations in mortgage production and subsequently affecting revenue. Loan demand and liquidity are also crucial factors that impact revenue growth or decline. The Mortgage Purchase Program, MPP, has been a major driver of revenue growth, with increased yields on assets and long-term cost reductions contributing to the company's success. Residential mortgage origination is another key driver of revenue growth, with variable commissions influenced by residential mortgage originations. Net interest income is affected by loan demand, economic conditions, yield curve slope, and absolute level of interest rates. Non-interest income is driven by gain on sale of mortgage loans, which is influenced by industry residential loan originations. Additionally, economic downturns and contractions can lead to a decline in revenue, while competition from other financial institutions and regulatory changes can also impact revenue growth or decline. Net income for the company decreased significantly due to various factors. Regulatory scrutiny, higher deposit insurance assessments, and adverse developments in the banking industry all contributed to this decline. Additionally, prolonged elevated interest rates, decreased residential mortgage origination, increased competition, and fluctuations in interest rates reducing net interest income also played a role. Furthermore, increased credit risk led to delinquencies, non-performing loans, and charge-offs, further decreasing net income. Losses on hedge instruments were another factor that negatively impacted the company's net income. However, despite these challenges, the company was able to increase its net income by $24.5 million in 2025 compared to 2024. Profit margins also decreased due to reduced loan originations and profitability, increased competition and regulation, and negative impact on mortgage banking services. The impaired ability to sell or securitize mortgage loans, reduced revenue from sale of loans and servicing fees, and valuation of mortgage servicing rights impacted by changes in interest rates all contributed to this decline. The reasons for these changes are multifaceted. Economic conditions affecting real estate values and liquidity, regulatory responses to economic conditions, and liquidity risks affecting operations all played a role. Increased competition from non-bank competitors and GSEs, reduced mortgage production due to high interest rates, and dependence on an active secondary market also contributed to the decline in net income and profit margins. The company's debt level and interest expenses have undergone significant changes. According to the extracted summaries, the total debt level has increased from $4.63 billion to $6.32 billion, representing a 37% increase. This trend is consistent across multiple pages, indicating a substantial rise in debt. Furthermore, interest expenses have also seen an increase, with some fluctuations, suggesting that the company's financial obligations are growing. The data highlights a notable increase in total debt from $1,302,683 to $1,536,415, representing an 18.2% growth. This significant jump is accompanied by a substantial rise in interest expenses on interest-bearing liabilities, indicating a potential increase in debt level. However, there are some discrepancies in the data regarding interest expenses, with one page showing a decrease and another showing an increase. In conclusion, the company's debt level has increased significantly, while interest expenses have also seen a notable rise, albeit with some fluctuations. These changes suggest that the company is taking on more financial obligations, which may impact its overall financial health. The company's performance across various segments and regions has shown a mixed picture, with some areas excelling while others remain steady. The Mortgage Purchase Program, MPP, stood out as a top performer, experiencing a significant 71.3% increase in net income before preferred dividends in 2025 compared to the previous year. This impressive growth is a testament to the program's effectiveness and efficiency. The retail banking segment also demonstrated strong performance, with a notable 33.4% increase in net income before preferred dividends. These results indicate that these segments are driving growth and contributing significantly to the company's overall success. Unfortunately, there were no areas mentioned as underperforming or experiencing decline in their financials. The company's acquisitions and divestitures are notable aspects of its business operations. In terms of acquisitions, there is a significant mention in page 42, but the details are not specified. However, it is clear that the company has made some substantial investments. On the other hand, the company has been actively involved in divestitures. One notable example is the sale of its correspondent lending business on page 6. Additionally, there have been frequent sales of participations in MPP facilities to third parties as mentioned on page 26. Furthermore, the company redeemed $77 million of 8.25% fixed-to-floating rate non-cumulative perpetual series, a preferred stock on December 30, 2025, as stated on page 51. Overall, these transactions demonstrate the company's strategic efforts to manage its assets and liabilities through acquisitions and divestitures. The company has a history of paying dividends to its shareholders. According to the extracted summaries, on page 26, it is stated that the company has paid dividends. Additionally, on page 60, specific dividend amounts are mentioned for the years 2025 and 2024 in the retail banking segment. In terms of share buybacks, there is no relevant information provided on pages 10 or 47. This suggests that the company may not have engaged in any significant share buyback activities during the period covered by these summaries. There are concerns about the potential for supply chain disruptions, but not inventory buildup. The main concern lies in the vulnerability of supply chains to various threats, including cyberattacks on local and state government databases and offices, page 30. This highlights a significant risk that could impact the smooth operation of supply chains. While there is no mention of inventory buildup or supply chain disruption on page 39, it is clear from other sections that supply chain issues are indeed a concern. The absence of any discussion about inventory buildup suggests that this particular issue may not be as pressing at present. That concludes the financial summary for NorthPointe Bancshares Inc. Feel free to comment below, and I will be happy to answer them when possible.